All right, what's going on everybody? My name is Brendan Murphy, and today I'm going to be sharing with you probably the easiest way that you can invest your money for a steady return with little to no ongoing effort. So the other day I was approached by someone and they were wanting to invest their money to make money. They had no knowledge about day trading. They weren't willing to learn. They just wanted to do something with their money to get a little bit of return over time. And so obviously day trading isn't the best option there. They want a set and forget method that's going to produce returns over a long period of time. And so that gave me the idea, hey, this is a good video to make for people who might not want to day trade or might not have the capital or just want something that's super easy that's going to generate a bit of extra income on the side. And so for people who don't want to day trade or don't want to scalp or don't want to swing trade, the most common answer I give is to invest in the lowest cost index fund that you can. Not to be confused with mutual funds. Mutual funds will charge you an arm and a leg for their service, and they will underperform an index fund 9 times out of 10. So what's an index fund? An index fund is basically an investment option that tracks the performance of an index. For example, the most common being the S&P 500. So when you invest in an S&P 500 index fund, your returns are going to be tied to the performance of the S&P 500 itself. So this is not an actively managed fund. This is a put your money in the S&P 500 and leave it. And since there's no active management, this is why index funds are the cheapest option. There's almost no ongoing fees because no one's actively managing your money. It really is set and forget. So when it makes a gain, the gain is yours. And when it takes a loss, well, you only take the loss. With mutual funds, when you take a loss, they're going to still charge you their fees. So with mutual funds, your gains, they take a bite out of your gains, and when you lose, they take a big chunk even when you lose. However, with an index fund, you win, you lose, you lose. Now, as far as how much you're going to win and how much you're going to lose with an index fund, generally over a long period of time, you're going to average approximately 10% per year on your capital. And then in terms of how much you're going to lose, well, every 4 to 10 years, you're likely to lose 25 to 55%. And usually that 25 to 55% drop will happen relatively quickly, probably in a span of a year. And then likely it will recover relatively quickly as well. And then you'll continue making the 10% per year again. In fact, the 10% per year return is actually including those 25 to 55% drops. So the actual returns you get if you cut those out, it's a little bit higher. But we have to factor those in to give an accurate view of what performance you're likely to have. Now, there are lots of different index funds. The S&P 500 isn't the only index fund. There are a ton of different index fund options. They're all probably pretty good. Obviously, I can't go through and analyze every single one, and I'm also not able to give financial advice in a video here, so don't take any of this as financial advice. This is simply some general information that might be useful for people who want to invest their money and don't want to do any ongoing work. So if this was valuable, please like it, maybe leave a comment on another tip you want to see. Share it with your friends if you think they'll find it valuable. And as always, please subscribe to the channel so that you never miss out on the latest ways to improve your investing. And with all that said, you can always find my professional services at mie.trade. Otherwise, thank you very much for watching the video, and I'll see you again tomorrow for the next one. Bye-bye.